So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, Kirk here again, and welcome back to The Daily Call. On today's call, we are going to answer the question, how can I tell if I'll be assigned trading stock options? So I think this is a big fear for people, especially when you get started in option selling, which is mainly what we do, where we sell straddles or iron butterflies or iron condors. People often fear being assigned stock. Now, first of all, it's not as bad as it seems. And yes, it will happen. It's going to happen at some point in the future. If you do want to be in this business long term, which I assume you do if you're listening to this podcast, then you just have to realize that it is going to happen. Now, we've got a lot of case studies on the website. We've got a lot of training on how you can manage it and some examples of positions where we've been assigned and we've managed it. It is not always bad. In fact, a lot of times it ends up being really well, being assigned the stock. So if you can deal with it, it's definitely something that works out really well. So the question again is, how can I tell if I'm going to be assigned? So if I know it's going to happen, how do I know? Or maybe like what indicators are there that I'm going to be assigned? First thing you have to understand about assignment is that it is random. As the option seller, it is the choice of the option buyer to exercise their contract or not. Now, the option buyer will typically do this, and I say typically, air fingers quotes, because they'll typically do this closer to expiration. Now, why is this? Why do option buyers generally wait until expiration? And the reason that they do is because at expiration, the option contract trades closer to parity, which means it trades closer to the actual intrinsic value of the stock to the strike price relationship. Now, anytime before that, then the option contract has time decay and volatility built in. So if the option buyer were to exercise that contract, they basically be giving up that premium that they would have otherwise gotten if they just flat out bought or sold back the contract in the market. So that's why they don't do it until closer to expiration, because there's all this time premium and volatility premium baked into the option price. If they exercise now, they're giving up that extrinsic value that's left in the contract, which they typically won't do. Now, this doesn't mean obviously that you can't get a random assignment, before that. So oftentimes maybe 2 weeks before or a week before expiration, we get a random assignment. It happens for sure, but it is absolutely the exception. It's not necessarily the rule to what happens. Most assignment, and you can go back to some of our podcasts where we talked about this on our weekly show with the OIC. We go in there and we look at their research and their data. Looks like most of the assignment actually happens the week of expiration, and even more of that assignment happens later in the week of expiration. So if you manage your positions early, like 5 or 6 days before expiration, you'll generally be fine. Some other things you want to look at and just to be aware of and cognizant of is obviously you're going to have a higher likelihood of being assigned if your option is deep in the money. So if you, for example, sold a 100 strike call option, and if the stock is now trading at 110, your call option is now $10 in the money. Now, at that point, you're getting closer to expiration or you're a couple weeks out. There's a higher likelihood that you're going to be assigned because there's probably not too much extrinsic value. The stock, as it goes, or the option contract, as it goes deeper in the money, starts trading more and more on just pure intrinsic value, or just like the parity value of the option contract. And so those option contracts that are deeper in the money have a higher chance of being assigned. Now, that also doesn't mean that as soon as your option contract goes in the money, it's going to be assigned. In fact, lots of our contracts sometimes go in the money or out during the month as the stock fluctuates. It doesn't mean that you'll automatically be assigned. The other thing that you want to look at as you get closer to expiration is you do have the ability, and most broker platforms, I know Thinkorswim and Tastyworks and some of the other ones, Interactive Brokers and all these other ones actually do have the ability to look at the actual extrinsic value versus intrinsic value of an option contract. What you want to be aware of there is that as your extrinsic value, or the time or volatility value of the option contract, goes down and starts approaching zero, then your risk of assignment obviously starts creeping up. So as the option contract starts losing all of its time value that's left, it starts trading closer to its intrinsic or real value if it were to be exercised by the option buyer, you have a higher chance of being assigned. Again, that only happens closer to expiration week. So it's, again, something you want to monitor. If you're looking at a short option contract and the extrinsic value or volatility value is like $30, probably still won't have a high likelihood of being assigned. But if it's $2, maybe the option buyer might give up that $2 in order to collect the stock, right? So that's another thing. The last thing that you want to look at is dividends. So dividends obviously come up in the middle of the month. That's something that we've talked about before on the podcast here, also on our weekly podcast and on the website. There's a lot of different examples of how to not only figure out if you're at risk of assignment with dividends, but also showing you a bunch of examples. So you can just search like dividend assignment or dividend risk on the site and find those. But when a dividend gets paid, that really is going to affect short call option sellers. So not going to really be affected as a short put option seller, but short call option sellers, if you're in the money and a dividend's coming up, it might be something that you need to be worried about. So what I usually do is I usually just like set up alerts for everything that we're trading to just let me know from the system when a dividend's getting paid. So I know I get an email and it's kind of top of mind. I don't have to track it or always monitor it all the time. So it's a really easy way to kind of streamline your process. So I know this one was a little bit longer today, but actually, I mean, these are still pretty short podcasts anyway, but hopefully this kind of helps out and kind of eases your fears or your nerves about, being assigned or how it works. As always, if you guys have any questions, let me know. And until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.